I think this is the Energy Tech Summit. So we're going to put a little bit of energy into these last few events, okay? We're almost done. We've got some fun things happening later, some parties, some fun events. So without further ado, we're tackling trust in voluntary carbon markets, which is a critical conversation on moving from greenwashing to credibility through better monitoring and verification. So please, let's give a warm welcome to our next upcoming speakers. First up, we have Tommy Ricketts, co-founder and CEO of BeZero Carbon. Welcome, Tommy. Next, we have Jason Aramburu, CEO of Applied Carbon. Welcome, Jason. Next, we have Mary Yap, co-founder and CEO of Lithos Carbon. Welcome, Mary. And then we have Michelle Yu, co-founder and CEO of Supercritical. And moderating this panel, we have Melina Sanchez, principal at AENU. Melina, take it from here. Thank you.
Thank you. Good. Hi, everyone. My name is Melina. I'm a principal investor at AENU. It's very difficult to pronounce. AENU, AENU, however you want to do it. Climate tech VC based out of Berlin, Germany. And today we're going to speak about building trust in the voluntary carbon markets. And we have a series of panelists here that will introduce themselves in a little bit. But just to frame the conversation a little bit, the voluntary carbon markets obviously are growing, or hopefully for all these amazing startups, more or less measure at 2 billion right now by 2035, depending on which source you look at. It's expected to be around 30 billion plus. Now the question is, with growth also comes scrutiny, and obviously additional trust that needs to be put into this market in order to unlock a lot more credits, and that's what we are going to talk about today. So without further ado, we'll start with defining what trust in the voluntary carbon market actually means to begin with. So passing on to Michelle.
Great. Hi, everyone. I'm Michelle. I'm co-founder of Supercritical. We're a carbon removal marketplace that helps buyers procure carbon removal credits. All pathways are represented from nature-based solutions all the way up to direct air capture. And by working with buyers every day, like Virgin, Atlantic, and BlackRock, we really see kind of the broader question of trust and the information and confidence they need to buy. So obviously, the climate integrity of the credit is first and foremost, and monitoring and verification is really critical to that. But beyond the crediting question of is this a ton of carbon removed, trust also includes things like transparency in the data, understanding what's available, understanding pricing and supply availability, which is a problem we're trying to solve with our marketplace, as well as assessing delivery risk to know whether the credit will be delivered in the future, and then understanding the kind of the social ecosystem of the project, whether there's co-benefits that you can talk about or damages to the local community, which also inspire trust. So we think about it kind of a bit more broadly than just the climate credibility of the credit.
When we think about trust in the voluntary carbon market, obviously everyone here has heard about the BeZero scandal a couple of years ago, which obviously has impacted trust in this space. How has the definition of trust changed over the last couple of years since that incident?
Yeah, that's a really great question. I think we exclusively deal with carbon removal credits, and we've actually seen a flight to quality. So the vast majority of credits are in the avoidance market. That's what BeZero deals with. And we've seen buyers kind of move away from avoidance towards carbon removal because there's this perception that they're a higher quality credit. And to measure a ton of carbon removed is a lot easier than to measure a ton of carbon avoided or reduced, I would say. So I think net it's been positive for carbon removal, but it does inspire a lot of fear and paranoia around greenwashing and reputational damage in trading in carbon credits.
Okay. And when a buyer of carbon credits is trying to understand high quality versus low quality credits, what are some of the criteria that the buyer would look into beyond some of the things that you mentioned before?
Yeah, I mean, they're the standard ones that all protocols and registries look at: permanence, leakage, additionality. Maybe one that we look at specifically that kind of surprised me when I first started entering it is not just the kind of the financial additionality of the carbon credit being paid for, rather than just the climate additionality, and that's an important one. But I mean, these guys answer these questions day in and day out for their projects, so maybe they'd be better placed to answer.
Does anyone want to add on the difference between high quality and low quality for any of your projects?
Well, so I'm Jason Aramburu. I am co-founder and CEO at Applied Carbon. We're a biochar company, so we supply biochar carbon credits. And I think biochar is somewhat unique in that it's a fairly mature market, and the methodologies have been around for a few years now. So there's really only one type of project at this point in biochar. It's either you're a certified project or you're not. And if you're certified, you have to meet certain standards. Your biochar has to be tested according to a certain schedule. So I think it's fairly unique in that regard, that it's pretty mature and pretty established.
What about in the case of enhanced rock weathering, Mary?
Yeah, so hi, I'm Mary, co-founder and CEO of Lithos. We are an enhanced rock weathering company, and what we do is we take a waste byproduct, this dusty volcanic rock from mines across the world, and we move it to farms where it permanently traps carbon. So it traps carbon for 10,000 years or longer. We deliver a certified, empirically measured carbon removal credit to our buyers, which include Google, McKinsey, Microsoft, and others. The key thing that we've seen as the carbon markets have evolved over the last decade or so is that at the start there's a lot of uncertainty about how permanent a credit was, how additional it was, as Michelle mentioned. How are you measuring this? Should you be measuring this? When we first started Lithos about 3 years ago, there was like this whole aggregation of ex-ante credits, where it's like, I did an activity and maybe it will capture carbon in the future, but pay me now. Lithos has never done that, and we're really excited to see the market move towards more what we're doing, what Jason's team is doing as well, where it's a permanent credit, it's carbon removal, as Michelle said, and we're actually on our team empirically measuring all the tons that we capture. So every 6 months, it's actually pretty intense, every 6 months we roll up to every project site that we have, we empirically draw samples out of the fields, see how much permanent carbon we have trapped, and then we deliver it to the buyer. So that's called an ex-post credit. So the transition from ex-ante, just activity-based credits, to ex-post empirically measured credits is something that I've seen in the last few years, and we're actually based on a decade of academic research. We're scaling up an academic method we've developed for cost-effectively and scalably measuring how much carbon we remove. So we're really excited to see the market move in that direction. Ultimately, we all know in this room that we need carbon removal. We need all kinds of solutions, but we need scalable carbon solutions that will last for a long time. And we really believe here that in order to have that lasting impact, you need to have trust, transparency in the markets. And so we're stoked to see the markets moving in that direction.
So perhaps to double click on the measurement and verification evolution in the market, I would be curious to hear, especially from the startups that are selling credits, how has that evolution from a technological perspective has been over the last few years? You mentioned, for example, taking samples. Obviously, there are technologies right now around satellite and other type of data sources that make it a lot more scalable. How has that improved or not? Also the trust in the market. Would be curious to hear from your startup's experiences, and probably you also told me see it more from a outside-in perspective as well.
Well, I can speak to from the biochar perspective. When I first started doing this, we did have to go out and actually take soil samples. Once you apply the biochar to the soil, our buyers were asking us to go out like a year later and confirm that the biochar was still there. And I don't know if it's the same for you all, but that's incredibly expensive to do. The frequency that you have to go out and do that, and the number of samples you have to take on a typical farm, it's not something you can do and sell a ton of CO2 for kind of less than $200. I mean, at that point, most of the cost is just paying someone to go out and do the soil samples. So Thankfully, the protocol has evolved to a point where you don't have to do that anymore. As long as you test the biochar itself periodically and you can send all the data from your production process and that can all be audited, the buyers will accept kind of that model-based approach. And at least for biochar, that's been essential to build trust and just to make it economical, I would say.
On our hand at Lithos, we're based on a natural process that already exists in nature, and the way that I like to explain it to my mom is the last ice age was caused by natural versions of what Lithos does. So the Himalayas uplifted, lots of rocks were now available that removed a lot of CO2 from the acid rain that comes down naturally in nature. And then that was transformed into solid bicarbonates, which are stored in the bottom of the ocean. Like, nature already does this. So in our particular case, we know that it will happen at some point, but it might be thousands of years. So in our current technology pathway, we're still in the phase of measuring at high resolution and very intensely how much carbon we're capturing in each field. A tricky and kind of capricious thing about volcanic rocks permanently trapping carbon is they do it differently in every single farm. Like, Farmer Tommy's farm over here might capture all of it in a couple years. This farmer, John, might capture it in 10 years, and that actually is part of the ex-ante, ex-post thing that we're talking about, like how quickly is this process occurring. So our model at Lithos is currently on every single of the tens of thousands of acres of projects we have today. We do actually measure how much carbon we do at every single site, every 6 months, ongoing, but we're also creating the world's largest database of enhanced rock weathering data. Our vision and our goal as a company is to actually develop something like the Google Maps of enhanced rock weathering, where based on the data, based on the soil types, the climate conditions, the other conditions on Farmer John's and Farmer Tommy's farm, understanding and being able to predict how much carbon will be captured by similar farms in the future, and then still empirically auditing that over time. So we're pushing methodologies towards that direction. We think that trust and transparency is vital in the foundational stages of any market, so we're focused on that stage, and we would love to be building models in the future, and that's what we're also investing a lot of our time and energy on. But you're absolutely right in that the cost for MRV is high, and so we're very grateful for buyers who are helping invest in that initially, so we can get, like, it will literally slash prices by 50% for enhanced rock weathering once those models are developed.
So perhaps getting the outside-in perspective first, but then I want to come back on the cost of MRV.
Yeah, so I'm Tommy. I run a company called BeZero. We do carbon ratings, so we don't sell credits and help them with the procurement process, and we don't build them. We essentially create analytical infrastructure like bond ratings to try to essentially create the information rails for the market. What do you actually do, right? So you're going to hear these great stories from very, very good actors, but there are 50 other projects who are all doing very similar activities, who all follow in the same protocols, of which there are about 70 all over the world. The outcome essentially is supposed to be the same, which is a ton of carbon, but it's not the same. And a rating essentially treats it as probabilistic. So to what extent is it actually achieving on that claim? And so our job is to come in and go, for every single one of the sectors, from biochar to enhanced rock weathering, we have to build out all our own independent data sets to interrogate on a case-by-case basis, bottom up, every single one of these projects. And then you provide a rating, which provides you essentially a risk metric, a benchmark from which you can go and essentially understand pricing, cost of capital, do due diligence against, and it's like a framework to do that side of it as well. So that's where we come in. So every single time that they have to do these things, we have to basically have to pick their pocket and go, well, you're using this data, so I'm going to use 15 other data sets to basically figure out what I think and what they think, what you're all doing against each other. And that is a different layer of, so when you guys talk about trust and transparency, I come from a market analyst job, that information is readily available to you to assess a liquid asset class like public equities, and when it gets to you, well, the number in the 10K is not wrong, right? The EBITDA you see on that file is real. That's an audited accounting data point. It's not that easy in carbon markets. No one has done this fundamental work. So, like, for example, just the standardization. Every single one presents it differently. There is no standardization in the way in which you present the information. There's no agreement on some of these variables. So that's a lot of where we come onto the sort of design side. And on the actual day-to-day analysis side, we have a team of nearly 200 people now, which of 100 of them are sector specialists who are themselves basically going in and building these models. The challenge is to make them all speak to one another. So additionality in a forestry ecosystem versus additionality in a mangrove versus a biochar versus a direct air capture, it is all the same mechanics, but they're very different things. Carbon accounting is all the same mechanics, but they're very different things. I mean, think about the heterogeneity of the companies you've seen on this stage. They all have a balance sheet, they all have a pitch, but valuing those companies on this stage, wildly different skills that you need to do that. Anyway, so that's kind of where we come in, but our job is to hopefully provide a mechanism to basically accelerate the speed at which the market can do that work itself, right? So you've got to scrutinize the claims of the people that are going to be presenting it. Every developer will tell you that they're the best in the world, and they should. Likewise, everyone will tell you, I'm selling you the best credits that you should. But you'd want third-party data sets to provide you with your own tools to figure that out. And that is actually, in and of itself, a more sophisticated market structure. So where we come in versus the press is we don't say, you're wrong, you're a baddie, go to jail. We say, here's the way statistically that you're being pretty woolly with the way that you're evidencing these points. You know, you've picked a distribution where, let's say there are 10,000 different types of outcomes, and you picked the best possible outcome that was available to you. That's not good practice. Here's what good practice looks like, and these two are very good actors. And so, you know, you trend capital decision-making activities towards best practice, so you get a virtuous cycle, as opposed to being like, look, I have no idea how to interrogate these things. Like, where do I even start? And then it's my scientist versus your scientist and all this sort of stuff, which gets through. It's not systematic, basically.
I mean, that's interesting because part of the 2023 VERA scandal was also around how independent were third-party verifiers, really.
Yeah.
And where you're coming is providing that additional layer of independence in comparing across different projects.
So we're outside the value chain. So to build a credit, so everyone understands, you've got an activity which you can define which will save or remove carbon. You need money from the carbon finance to do that. If you don't need money from carbon finance, you don't really need to use carbon markets, right? So you don't need to build carbon, you don't need carbon markets to finance renewable energy in the UK or whatever like that. You just don't need it. The next thing is you've got to get an investor to give you the money to do it, or you do it yourself. And then you go through a methodology, you get them accredited, and someone will check that work. So that's not a bad process. It's just that the actors in that process it was just small, right? You know, you're talking about a bunch of NGOs who started this thing. You know, you've got capital market infrastructure and risk takers coming in who are expecting a certain level of scrutiny and credibility, and that's not really a fair, prism through which to assess the activities that these guys were doing. They were there to save the world. They weren't there to justify to a risk committee at JP Morgan the activity of they're just cross purposes. So that's part of it as well, is that they were just not really set up to be open to that level of scrutiny, and they were obviously found wanting.
Yeah. And it's also part of the maturity and the evolution of the market, right? And if we scale 10x, 100x more, obviously the level of scrutiny will also go up. But going back for a second on and closing this topic of evolution, something that you mentioned before around the economics of MRB. It sounds like it's almost one of the last pieces of the equation to really scale carbon credits, right? Getting these costs down in a way that is still trustworthy and transparent. So in the case of Lithos, how will you, I think you mentioned 50% down, hopefully. How would that work exactly?
Yeah, great question. So MRV costs are significant today because we draw these soil samples high resolution, we put it through an ICP-MS machine and shoot little electrons through it and measure it parts per million, how much carbon we've captured. That all takes some amount of cost and time and energy. One of the key things here is economies of scale. So at the moment, Lithos is live on tens of thousands of acres. We've moved over 300,000 tons of rocks, and simply by doing more samples, this is the same as any normal industrial product, just by doing more samples, the cost of those samples has come down for us. We also run our own laboratory in Mountain View, California now that has also helped us reduce our costs. So in some ways, there are little iterative step function changes that can happen with the cost of this empirical empirical MRV. The second stage that we see is actually developing models, as you were mentioning. So we are working on using our data, which is the largest enhanced rock weathering data set in the world, developing predictive models to understand how exactly is this going to work in this kind of soil texture and this kind of soil biogeochemistry. How quickly will this capture carbon? And then testing that by auditing it with the normal empirical MRV we do. That's a stage 2. And then stage 3 will be really moving towards that direction where you're only drawing a sample every so often to check that. And then at that point, the full cost of enhanced rock weathering and a carbon credit there, it's really just a little bit of logistics. You're taking the volcanic rock dust, which is a waste byproduct. Like, this is a product that quarries or mines across the world already produce in millions and billions of tons. They don't use it, they don't sell it, so it's very cheap or free. We take that, we move it to farms, and then you make sure it's applied properly, and then you predict how much it's capturing, and then you sample it every so often. And in that case, that's a very cost-effective solution. It's a circular economy. It's completely a waste byproduct being applied to farms with equipment that farmers already need or already have, and it improves crop yield. So along those lines, we know the cost of carbon removal with enhanced rock weathering can be below $100 a ton once we solve the MRV thing. So a lot of the times, an investment in the enduring long-term impact of a market requires a lot of trust, transparency, and hard work at the start. And that's what we're spending a lot of time and energy vouching for and doing and spending our time and resources on. But after we move past those couple chapters, those couple stages, we're really excited to move ERW into a below $100 a ton market, something that's globally scalable and much faster to scale because you're not pulling soil samples every 2.5 acres every 6 months, and in a way that's really good for farmers as well.
So let me just test you a little bit. You mentioned a few things that could be levers for reducing the cost of MRP, economies of scale, new models. What is the single one lever that would really reduce the cost among all the ones that you mentioned? Data.
Yeah, so data to develop those predictive models. Then in that case, you're not doing the labor, the ICP-MS work, all of this. So developing predictive models. And in a time like, the last talk right before us was about AI and the power of AI, we really believe in that. We have very base models that we've already developed in partnership with AWS and the IRCAI, so International Research Institute for AI has been supporting us in the development of these open models. So that would be the biggest lever. But as with anything else with AI, it requires some amount of data. So we're working on that.
And Supercritical sells credits from different projects. So you probably also see different types of MRV technologies that different companies use. Do you see MRV in terms of the cost being the one lever across all the different types of carbon removal and reduction technologies that being the key challenge in the ecosystem, or do you see other challenges that are as important as reducing the MRP cost?
Yeah, I think it depends on the technology pathway, but from our time working with suppliers, the single biggest constraint to their growth is the demand on the demand side to help them get to those economies of scale, right? So having buyers who are able to take risk and sign long-term offtakes, which then unlock the project financing these projects need to then grow and scale. Like, I would say it's this like classic chicken and egg challenge. But on the demand side, I think once you get comfortable with carbon removal and have made the commitment and built it into your budget, an offtake is a no-brainer because it gives you a stable price per ton in a volatile market and a discount to the spot market, which is only getting more and more expensive in the supply constraint. So that's the piece of the puzzle we're trying to help projects with. We don't, sometimes we get the full kind of breakdown of the costs, not all the time with the projects, but the thing that they come to us with is we need demand in order to scale and make things cheaper.
Fair, and as you said, it's a bit of a chicken and egg problem.
Yeah. Can I just add, so just to give a holistic picture, you've got two very different cost curves in our market. You've got nature, which needs to be essentially more expensive, and you've got technology, which needs to be cheaper. So they have different dynamics. Mm-hmm. So what you're talking about is an innovation cycle, right, where in which you'd have subsidies that do that. But in this instance, corporate spending in carbon markets is one of the biggest forms of innovation subsidy that's going on. But the weird thing is they're incentivizing you guys to be cheaper, right? So you are actually trying to get people to pay more expensively for their future customers to be cheaper. So that is literally, that's an economic fallacy essentially, which is very interesting. Whereas by nature, you're saying, and you could just debate how much you guys think these are equivalent, but it is like $2 to $5 to $10 some of the cost of delivering these very high quality projects in very endangered ecosystems. So are they equivalent? That's a very big challenge, because there's enough for everyone to eat there. But in carbon markets, you've got 10 cents to $1,000, and it's just the economics of these projects are very different. Large-scale mangroves in Pakistan, the economics are very different to building ERW systems across American agriculture. Right? They're just different value chains. They have different costs of production. So then it becomes about buying behavior and what's eligible for different types of markets. So I think that yes, MRV is a big point for some projects, but I think that they are just genuinely super different products that have themselves just intrinsically different marginal cost of production.
And to what extent do you think that buyers are educated enough on the different types of MRV and projects and how to compare? I mean, other than obviously the very big tech buyers that are at the front running of the market, where they are buying a lot of, especially of engineering credits. But if we are thinking about the mass market, that it might not be here yet, how educated are they?
I think a lot of them are quite sophisticated with regard to biochar. I think a lot of them are like, companies like Microsoft are building internal teams kind of, dedicated to biochar. I think one thing we're seeing that's interesting in the biochar market is a lot of the buyers are pushing for more validation of the agronomic benefits of biochar, because it is good for the soil. It does increase crop yield, but it's not going to increase crop yield by the same percentage everywhere and in every crop. And I think a lot of these buyers want to see that side of the market monetized as well. Ultimately, where the farmer is paying for the biochar, based on the projected yield improvement, and that's pretty hard to do. It's pretty hard to quantify that, but that's something we're definitely seeing in the market that's kind of unique.
Although you mentioned Microsoft, right?
Yeah.
And the question when we were talking about trust in the market and understanding of what measurement verification means in this market, the hope is that we can unlock a lot more than just the big tech companies. So from other experiences, to what extent beyond Frontier, beyond Stripe, beyond Microsoft, where are we in terms of understanding and therefore trust?
Yeah, I would say, Microsoft and Frontier buyers are very special catalytic buyers, and the vast majority of companies that have a net zero target and a certain amount of carbon removal they need, you have to imagine they're like 2 or 3 person sustainability teams that are mostly focused on carbon accounting and their decarbonization strategy and their internal carbon price. They don't have the ability to really tell the difference between biochar and enhanced rock weathering in it, and that's where the standardization is really important, and that's kind of where the role we try to play is we're that outsourced procurement team where we have the vetting reports for every project on our marketplace so they can read and assess, in a like-for-like comparison way, which ones fit their budget and which ones they like for whatever reasons, the co-benefits for the farmers or other reasons that align with our brand. But it's a really tough time to buy carbon removal, I think.
Is this because of what's happening in the US, or are there other factors that are basically disabling the mass market to play a role here? Yeah,
I think, the biggest demand blocker, I think, is SBTI having good carbon removal guidance, which they're, trying to get to with this new draft out, where they, a third of global market cap has made a net zero commitment in SBTI, and up until very recently, they enabled companies to just wait till 2050 to buy carbon removal, which doesn't make any sense because we won't have it by then if you don't buy now, and not having those interim milestones. So other principles like the Oxford offsetting principles help that, but corporates want more prescriptive, clear targets to set, not just make some path forward and increase over time. They want more prescriptive guidance. So I think that's the biggest thing that can unlock demand ahead of regulation.
Okay. No, it's interesting, obviously, because we read in the news these days about the backlash in climate tech generally, right? And a lot of companies have been forced to ride the wave so far. And the question for me and for many investors is it the clarity in the rules? Is it regulation? Or are there any other fundamental drivers that can unlock the market, whether it's from a trust perspective, but also any other angle that a corporate might have to play a role here?
What do you think? You're an investor.
Well, I'm not a panelist.
I can give you our perspective. I agree with Michelle. It's not the room for this. We'll say at New York Climate Week, but it's hard to underestimate. Okay, so there are 4 reasons you buy credit. Philanthropy, that's not a market. Claims, which is what caused the boom, which got us all funding to begin with, i.e. I want to show off what I'm doing, and therefore I want to make a claim around it. That's basically being killed by scrutiny. Then you've got transition frameworks, which SBTI is the biggest. It's about 15% of global emissions are substantiated by SBTI, which says don't buy credits. We estimate that's about a $100 billion market just sat there. And then you've got regulation. Regulation is just happening slowly. So in general, credits will all be used in regulated markets. Just a question of when. But in the short term, conversation we have many times, I'm sure, in different audiences with different people. So, these guys' pitch will be, how do I get into compliance schemes? And if Trump's tearing up the California scheme this week, then that will be very tricky to figure out what's going on there. From our perspective, it's like, how do we convince the transition frameworks? And you go into the government, so that's kind of what it's about, right? Corporates need risk cover. And they've all subscribed to SBTI. So again, not for this audience, but basically SBTI is corporate climate action. That's it. In a nutshell, it's one acronym. If they do not move on this, and I spoke to their CEO 2 weeks ago, the new one, it's going to be slow. But they are being a little bit nicer, particularly to you guys. I'm not sure about them. But just another point, The Guardian's about to release a whole new series of scandals. Start focusing on biochar.
No.
So that's coming.
Oh boy.
Oh.
Coming, I don't know when, but I know it's coming in the next couple of weeks.
Great.
So, the tractors are not going away in this space. But, it's really about, can you convince corporates under the regimes that they are subscribed to basically do this? I don't think it's a trust problem. I don't think it's an infrastructure problem. I think you guys have created here, you've got the living examples of amazing startups that are solving all of these problems. There's just no systematic buying. That's my pitch to governments.
Well, we don't know if we have any government officials here, but definitely key takeaway. And just wrapping up the conversation around what the future of measurement and verification might be for this industry. We talked about, again, the cost of MRV. We've talked about the demand side. What are the next steps that you see, the key evolutions over the next 12 to 24 months in measurement and verification, perhaps from the developers?
Well, what's happening right now in biochar, which I think is interesting, it's the permanence. So traditionally, biochar was considered kind of a 100 or 200 year permanent pathway. And in the past 12 months, there's been a lot of research on how to validate the permanence at 1,000 years or greater. And so some registries are now starting to accept that testing regime to certify credits at higher permanence. And I think, that kind of momentum will continue. I think that'll be really interesting because for the buyers, they won't have to make buying decisions based on permanence anymore. They can make decisions based on price and co-benefits when they look at biochar vis-a-vis, other technologies. So I think that'll be pretty cool.
On our end, we are exponentially getting more data, as I mentioned, on the speed of our carbon capture, and it is already a permanent 10,000-year pathway. But something that we're really excited about is something that you just touched upon, which is the co-benefits for farmers. We've invested all of this time, resources, and energy in the fun, permanent side of it on Lithos, but we also see out in the fields improvements of crop yields of 10 to 30%. Some of this is peer-reviewed and published, of 12% crop yields in a 5-year study. These benefits are really exciting. We are partnering with MIT on a study of how enhanced rock weathering can improve the moisture retention in soils, and we are seeing droughts across the world, not just in America, and moisture retention in soils is a really important thing just for our food supply. So we're also really excited to lean into data. My answer is usually data, but we're really excited to lean into data on the co-benefits of the product we're doing, because at the end of the day, my family are actually farmers in Taiwan. You want farmers to do biochar and enhanced rock weathering. That is the most scalable pathway. Exactly. Tommy's talking about there's all of these structural issues in VCM. I think we fully agree, but if farmers are doing things that they know are better for the grounds, that they know are scalable, that's actually how you capture a lot of carbon and remove it from the atmosphere, and then you've got the benefit of you're helping the atmosphere, but you're also decarboning decarbonizing agriculture as well. So that's what we're investing a lot of time into in the coming 12 to 24 months.
Great. And looking at the time, because we don't have a lot of time left, perhaps in the last couple of minutes, if there are any questions from the audience, one or two for the panelists, we might have some time. I see a hand here.
Hi, thanks. I just wondered whether you wanted to or could comment on how you see things panning out in relation to your schemes and also, Tommy, your rating system in relation to Article 6.4 and the decisions and the move forward from Baku. So getting the voluntary carbon market kind of recognized under the Paris Agreement and linking market mechanisms into that. So kind of almost kind of a regulated scheme, but actually moving forward with a common set of rules. Yeah. So that's not been kind of mentioned in the panel.
So the things that you have to bear in mind, the credits that are generated by these types of projects, excellent projects, they are equivalent, they're eligible in all kinds of markets. So that there's no I mean the protocol that you get to may differ, right? So you have to to be eligible for the regimes, but there's the same project, right? So you can have the same biochar project eligible for an Article 6.4 transaction, Article 6.2 transaction. There's different types of markets, a domestic compliance market, a local carbon tax. You can have it for a voluntary credit. It doesn't matter. So they're potentially harmonised already. 6.4 is the UN's trading scheme. That's up and coming. 6.2 is alive and kicking. Like we already do ratings for countries, looking at other countries and their procurements. So that's already going. And the biggest actors there are essentially Singapore, Sweden, Switzerland, and then you've got Japan's got its own scheme called the Joint Crediting Mechanism. But they're alive and going, right? And then you've got lots of domestic schemes going on in other parts of the world. So that stuff's happening. That is the ultimate direction of carbon credits. They will all work ultimately. I mean, there's an irony here, which is that nothing that anyone does is like every single transaction of any financial asset is voluntary. Just a little quirk. The fact that it's called voluntary is really just defining the corporate incentive underlying that. So there won't be a corporate incentive, it will be a mandate that will be requiring that. So in that sense, it will shift to compliance on a purchasing decision. But the credits themselves, I think that you'll see a lot of these credits coexisting across those different markets. That's in a global situation. Otherwise, it will balkanize, and you'll get essentially different markets at different places, and there'll be adjustments. But that stuff, that's a whole other conversation. It's a whole other panel.
Any other questions? If not, I think we can wrap it up here. Thanks a lot for the experts in the room. And I hope that with this tone of positivity, we see an inflection point in the voluntary or not so voluntary carbon market in the next years. Thank you.
Thank you.
Thank you.